Gold and silver prices have just shocked the global financial markets. Investors around the world are struggling to understand what just happened. Headlines are calling it a historic collapse. Social media is filled with fear and confusion. Some are calling it manipulation. Others are calling it the end of the precious metals bull market. But history tells us something important. Markets rarely move without a deeper reason, and they almost never move in a straight line. Today, we are breaking down what this crash really means. This is not hype. This is not fear-mongering. This is a clear-eyed analysis of gold and silver. Let's start with what we actually saw in the market. Gold fell sharply from recent highs. Silver followed with even greater volatility. Trading volume spiked dramatically. Futures markets experienced heavy selling pressure. Stop-loss orders were triggered across the board. Leverage magnified every move. Many retail investors were caught off guard. Emotions took over decision-making. Fear spread faster than facts, but panic is never a strategy. To understand this move, we must zoom out. Big market moves rarely have one cause. They are usually the result of multiple forces aligning. The first factor is the US dollar. A stronger dollar puts pressure on precious metals. This relationship has existed for decades. As the dollar rises, gold often struggles. Interest rate expectations also play a major role. Higher rates increase the opportunity cost of holding gold. Bond yields moved higher. That shift attracted capital away from metals. At the same time, institutional investors began taking profits. Gold had already delivered massive gains. Many funds locked in those profits. That selling created downward momentum. Algorithms amplified the move. Modern markets are driven by machines. When key levels break, selling accelerates. Liquidity dries up quickly, price gaps form. Retail investors are left reacting. This is how sharp sell-offs happen. But does this mean gold is finished? History suggests otherwise. Gold has survived every financial crisis. Gold has survived every currency regime. Gold has survived wars, inflation, and deflation. Silver has also played a critical role. Silver is both a monetary and industrial metal. That dual role increases volatility, but it also increases long-term importance. Many investors forget this during sell-offs. Fear narrows perspective. Smart money widens it. Let's talk about the trap theory. Market traps are psychological events. They are designed to force emotional decisions. Fear pushes investors to sell low. Confidence pushes them to buy high. This cycle repeats endlessly. Media narratives often reinforce this behavior. Negative headlines attract attention. Attention drives clicks. Clicks drive fear. But fear is not analysis. It is a reaction. Long-term investors focus on fundamentals. And the fundamentals have not disappeared. Global debt remains at record levels. Governments continue to run massive deficits. Central banks still hold large gold reserves. They understand gold's role. Inflation risks have not vanished. Monetary policy remains fragile, one crisis away from reversal. These are not bullish fantasies. These are structural realities. Silver demand is also evolving. Renewable energy relies heavily on silver. Electric vehicles require silver. Technology continues to consume more silver each year. Supply growth remains limited. Mining is capital-intensive. New discoveries are rare. This matters long-term. Short-term price does not change utility. Professional investors understand cycles. They expect corrections. They prepare for volatility. Retail investors often expect straight-line gains. Markets punish that expectation. This sell-off reset positioning. It flushed out weak hands. That is uncomfortable but necessary. No bull market survives without corrections. Corrections build the foundation for future moves. The key question now is not what happened. The key question is what comes next. Smart investors are watching specific signals. They are watching price stabilization. They are watching volume behavior. They are watching reactions to economic data. They are watching central bank communication. They are watching geopolitical risk. Markets move on expectations, not headlines. Expectations change quietly. Emotional investors seek certainty. Markets never provide it. Strategy matters more than prediction. Risk management matters more than conviction. No one knows the exact bottom. Professionals never pretend they do. They scale positions. They wait for confirmation. They remain flexible. Flexibility is survival. This is not financial advice. This is market behavior analysis. Every investor has a different time horizon. Short-term traders see chaos. Long-term investors see structure. Both perspectives can coexist. Problems arise when they are confused. Gold and silver, not day trades for everyone. They are strategic assets. They hedge against uncertainty. Uncertainty is increasing globally. Economic cycles are maturing. Debt servicing costs are rising. Political instability is growing. These pressures do not disappear overnight. Markets may ignore them temporarily, but they always return. Gold historically responds to that return. Silver often follows with leverage. Volatility is the price of admission. The biggest mistake investors make is emotional timing. Selling after panic has peaked. Buying after confidence has peaked. This pattern destroys capital. Education protects against it. Patience protects against it. Process protects against it. Markets reward discipline. They punish impulse. This moment is a test of mindset, a test of preparation, a test of understanding. Gold did not lose its purpose overnight. Silver did not lose its relevance overnight. Price is what changes. Value evolves more slowly. The difference matters. Investors who understand that survive cycles. Those who don't repeat mistakes. No one rings a bell at the bottom. No one rings a bell at the top. Markets move quietly before loudly. Watching behavior matters more than opinion. Reactions matter more than predictions. This is where discipline separates outcomes. Some will panic. Some will prepare. History remembers the second group. This sell-off will eventually become a case study. It always does. The question is your role in it. Observer or participant. Emotional or strategic. Reactive or prepared. Markets do not care about feelings. They reward understanding. Gold and silver remain complex assets. They demand respect. They demand patience. The story is not over. It is simply entering a new chapter. Volatility often marks transitions. Transitions create opportunity, but only for those who survive them. Education is survival. Risk control is survival. Long-term thinking is survival. Short-term noise fades. Structure remains. This is why moments like this matter. Not because of fear, but because of clarity. The market just revealed something important. Repositioning has been cleared. Expectations have been reset. The next trend will form from here. Slowly at first, then suddenly. That is how markets move. The goal is not to predict every move. The goal is to survive and adapt. Gold and silver reward patience over time. They punish emotion instantly. This crash is not the end of the story. It is a test of understanding. A test many fail. A test some pass. Markets are brutal teachers, but fair ones. If you respect the lesson, fear will fade. volatility will normalize. Opportunity will reappear. It always does. The only question is preparation. Panic creates losses. Strategy creates longevity. Time reveals truth. And markets always reveal truth. This moment will be remembered, not for the crash, but for the decisions made during it. Gold and silver remain mirrors of confidence. Confidence is shaken, not destroyed. Shaken confidence rebuilds stronger. That is the cycle, that is the market, and that is where opportunity is born. Not in comfort, but in uncertainty. Stay rational, stay informed, stay disciplined. The market will do the rest. History always does. This is not the first crash, and it will not be the last. What matters is what you learn, and how you apply it. The choice is always yours. Panic or preparation, reaction or strategy, fear or understanding. Markets reward the prepared and punish the emotional. Gold and silver are no exception. This is where the story truly begins, not ends. Thank you for watching. Stay sharp, stay disciplined, and stay focused on the long term, because that is where real opportunity lives. See you in the next analysis. The market is always teaching. The question is whether we listen. Until next time, stay rational, stay prepared, and never trade on fear alone.